Good evening, and welcome to a special edition of Fort Wayne Up Close. Today, we're going to be talking finances. I know we do a financial podcast on a regular basis, but today we're going to talk a little special finances. Each and every one of us has a job, and we have 401ks, and there's that period that they call open enrollment. How do we know what to do with our funds? What is the best use of our funds? I've got a couple of experts here today to actually talk about that. So I'm going to introduce my guest. I've got from Lake City Bank, Reneta Thurairatnam, which I've been practicing all day.
I'm impressed, JJ.
Thank you. I was going to say I got the smile from her. Reneta has been in banking for over 27 years. She is one of the stars at Lake City Bank. If I've got questions, I can walk over to her office and ask her. She's always there to lend a good answer and answer any questions that I may have. And then the person who actually brought about the podcast for today, I've got Tim Carswell, young man that's been in banking for over 13 years, T?
That's correct.
I'm lucky today. I'm 2 for 2. But Tim, I'm going to call him T, so just to get it out there. But Tim has been in banking over 13 years. He called me one day. He watches a financial podcast, and he said, hey, I've been in banking for 13 years. I've got some questions I want to ask. And I thought, hey, he's got questions. I told you my relationship with Reneta. I'm going to bring these two together, and we're going to go from there. So how do you want to start this, T? You want to ask your questions? I'm going to give you the floor.
Man, I first just thank you for having me on. Thank you, Reneta, for joining. I'm a fan. So I watch this show all the time, and I just think about it from being one of the people that some of my friends reach out to ask questions, and so I'm full of questions, right? I'm not full of answers right now, but with my 13 years of experience, I've been that middle person for a lot of clients, a lot of people, and overall, I think just today, just wanted to just dig into you guys' brain, your brain, and just kind of start off. So one of my first questions, this is one of my main questions that I'm having lately, and this is personally, but I think when I think about retirement or 401k, right? So this question's around that, but we have a lot of companies who will ask for or will offer a match of some sort. So let's just say a match of 5% for the sake of this conversation. But in that match, I'm always curious. In that 401k, how much more than the match should we invest, right? And then I just want to start that conversation from there. But should we max out our 401k or should we invest to the match? What is your thoughts around that part?
That's a great question. Do you want me to call you T or Tim?
You know what? T is perfect.
All right, T.
Let's go with it.
So the answer is it depends. And I'm sure you're used to seeing this with the people that you work with as well and even your friends. So let's say somebody's living paycheck to paycheck or they don't really have a lot extra, right? So for them, yes, you want to save for retirement. And if you're able to get that up to that 5% match, fantastic. I mean, that's double your money right there. You don't want to leave that on the table. But if you don't have extra and you need money for emergency expenses like, my transmission just went out, or those sorts of things, you really can't go to your retirement plan to get that out because you'll get a penalty. So it's important to have that emergency savings account too. Now, let's say you've got an emergency savings account, and what I like to see there is 3 to 6 months of what your expenses are, like your needs, taxes, things like that, car payment, house payment. If you are a double income, then 3 months. If it's a single income, 6 months. Or let's say you're a double income, but one of you is making a lot more than the other one, 6 months again. So if it's something like that, you've already got that established, then absolutely put as much as you can towards that retirement. So the way the 401k works, the money that's going in, you're not being taxed on it because it's taken out pre-tax. So that year you're not paying any taxes on it. It grows tax deferred for your future. And so that's just compounding interest and income for you for the future, right? Does that answer your question?
Yeah.
All right.
Dig in a little. Oh, go ahead.
I was just going to say, to piggyback off what he's talking about, he said the 401k. So how does somebody differentiate from investing in a 401k to having their own personal investments or something outside of that? What's your advice to that?
So my recommendation would be, the 401k with the match, you definitely want to get all of that. Emergency account, you definitely want to do that so that you have that for those those expenses that just crop up. But then other investments, so let's say you've already put everything in the 401k, you've got your emergency savings. When do you need that money for? So part of it is the goal, right? Mm-hmm. And I think when I talk to a lot of my friends that aren't in the finance industry, the idea of saving money for some future thing, it has to be tangible, right? And so we actually have a program on our Lake City app. It's called Goals. And I think we started that maybe a couple years ago. And it's really helped people because you put on there, like, for example, my sister wants to do this trip, a Rick Steves adventure in Europe, right? And so that's one of her goals. And then she's saving specifically for that. Now, she wants to do that in a year. So an investment account, if you're putting money there, you really want to look towards the longer term, so maybe 3 to 5 years. Because if you have a year like last year, fantastic, double-digit returns. If you have a year like the year before, double-digit losses, and then you're supposed to take that out to go on vacation. So,
yeah. So, okay, this to dig in a little bit more, and you did answer some questions, but to dig in a little bit more, when I think about this, I think about let's say. I'm going to give you an example of a person, right? So let's not call it me. Let's call it someone. So someone's investing, right? And
John. His name's John.
I like John. Okay. I like the name John. Let's go with John's investing. And John's company is going to stick with the 5%, matches at 5%, right? John has 3 to 6 months of savings put aside, so separately. And John is currently investing, let's say, 12%. So he's investing 12% into his 401k, so the match is 5%. Mm-hmm. So he's above the match by 7%. What would you say there? And the question I ask in this, and let me go a little bit further, the reason why my questions come up is because of the restrictions that then come along with the 401k, right? So as you said, an investment long term, right? But a 401k is an investment to a certain age, right? And I think as of right now, it's 59 and a half at the earliest, 72 at the latest. So with that being said, if I want to retire early, John wants to retire early.
That's right, T.
Yeah, John wants to retire early. Then what should John do? And that's the question. That's more so the basis of this conversation. John wants to retire early. He's investing over the match. What should John change right now in order to retire by age 50 if John is 30?
Okay, so if John wants to retire early, he's got to do a lot of calculations. Mm-hmm. So first of all, expense-wise, if you think about health insurance, so right now that's probably paid by John's employer, right? Mm-hmm. For Medicare to step in, which is what retired people use as their health insurance, you have to be age 65. Mm-hmm. So from ages 50 to 65, assuming he's retiring then, he's got to fork over whatever the expense is for healthcare. There's a group called Milliman, and they do like healthcare insurance studies every year, just across the board to see like what people are paying. And right now, that amount is over $10,000. For that year, and that's just base. And then the out-of-pocket is close to $4,000 for base. But then if John has any health issues or things like that, keep adding on, and then with inflation, so from now to then. I think last year, looking at it, it was already up over 5%, almost 6% this year's cost. So if you keep sort of funneling that forward. But so I do have a lot of people that, and I don't know if it's born out of COVID, but there's a lot of people where they just decided, you know what, life's too short. I am going to work hard. I'm going to hustle, grind, but then I do want to retire early. And so you have to look at those expenses, debt, whatever debt John has, how's he going to pay that off? Because the goal would be when he turns 50 to not have any debt, and then to be able to take care of his health insurance, any other expenses, whatever else he wants to do, travel, things like that. Because once you're out of the game, it's hard to get back into it again.
Yeah. The game meaning work?
Work, yes. So let's say John at 50, he's like, peace out, I'm good, let's go. And he's good for a few years, but then maybe a big health scare comes or something like that. And maybe he's now 60 or, 58 or something like that. Now he's got to try and find a job, but by the way, he hasn't been in the workforce for however many years. He's getting close to real retirement age, and so, that's a thing. Yeah. It's going to be hard for him to find something.
Yeah.
Well, John, T, I think she put a little something on your mind, huh, buddy?
I'm gonna have to talk to John about that. Talk to John about it. And I guess so. In that, in that, what's the best way to look at John? Okay, I think we did the math, right? We thought about how John wants to be at 50 as far as health wise, but from 30 to 50, what's the best way to maximize those funds? Is the best way to maximize those funds to put it into a 401k, knowing that he's not going to be able to touch it at 50? Or which way would you suggest if John's sitting in your seat at age 30?
So then you'd want to look at an investment account that's not a retirement account. Basically so that he can access it. You've still got the growth on it. So regardless of when it is that he decides to start taking the money out, whether it's later or before, there's some studies that are done that say 4% is kind of a safe number. So then you back into what dollar amount do I need to have? So you look at, okay, what are my annual expenses? Multiply that by 25, and then that's what your end number is. So let's say it's 80,000 by the 25, I think 2 million or something like that is what you would have to have in investment assets. So for somebody like John, he needs to have that in something he can pull out without getting a penalty. So he could just do a regular investment account. But he's still going to want to have something he can access without having to pull out in case the market's down. So there comes that savings account. So you've got your emergency savings. Maybe you have something in addition to that as a cushion too. And right now, money market rates are over 5%. So it's kind of a no-brainer. But, not too long ago, they were, 0.01, 0.05?
And some still are.
Yeah.
0.01, I think.
Yeah.
Oh, money markets?
Oh,
well, for the larger banks.
Some, yeah.
Oh, wow, that's what I'm just. Yeah.
That's what I hear out there. That's what John hears. Nice. Okay. Now, just to kind of continue along this line, and Jay, please interrupt me if you got something. But when I think about it, and some of my friends are also asking, so what are other ways? You hear a lot on the streets. A lot of people are saying things like life insurance policies, like whole life, and then you can pull out, and like that may be a way to access money at a certain time, like sooner. Any thoughts there, or what is your feedback around that stuff?
So I don't sell any life insurance products or anything like that, but there are products that are hybrid products that allow you to build up the cash value in it and pull if you need to or borrow against it. In the state of Indiana for long-term care, because that's another really big expense that people are finding. So we're living longer, right? I mean, the great thing is we're living longer. The bad thing is we're living longer. And so that healthcare expense is out there for long-term care and things like that. So there's a product where it matches dollar for dollar, like if you're in a home so you can protect your assets, but it has to fit all of these criteria to fit under an Indiana long-term care plan. And so there's things like that can be done. And usually when you are looking at long-term care, you are probably like in your 50s maybe. You don't want to be so old that there might be pre-existing conditions. You don't want to be so young that you're putting a lot of money away. And, if you don't have it or there's other things you want to do with it.
Nice.
So.
No, never heard that before.
Mm-hmm.
See, learning things.
I like it.
I told you, this expert right here.
I like it.
And he's coming in, he's at a level, and he's talking up here, which is great. And we have people that are listening. Like he said, he talks to people in the community that are in the same place he is. What do you say? There's people out there that have been trying to get off and go handle their own investments. We got all these different platforms, and they make it look so easy. What do you have to say about that?
So we saw a lot of this in 2020 because people were sitting at home twiddling their thumbs. There wasn't much to do. Stimulus checks are coming in, so there's a lot of disposable income. And we saw a lot of people that were opening up Robinhood accounts and things like that where you can go and buy. And I don't know if you guys are familiar with the whole Reddit stuff. Yeah. And so, there's a guy on Reddit that's basically saying, oh, GameStop, that's the one, or AMC, and everybody's buying, which basically pumps the price up. So when you're buying a stock, it makes it go up in value. And that's just, it inflates it that way. And so that's kind of the situation that he created. But if you don't know the things behind that investment, so for some people, they think investing is like gambling. Like, I'm just going to pick this machine, put my money in, press a button, and maybe I win, maybe I lose. I don't know. But the truth is, each company that you're investing in, there's value behind that, right? do they have a good product? What's their consumer base? How is it run? Those are all things that before you're investing, you want to look at. And I would say, if you're looking online and you're just trying to get your data there, it's really difficult to do all of that yourself and have another job unless you have a true love or passion for it, right?
Yeah.
Now, one thing that people can do is invest in mutual funds. So that's a lot of different stocks in one holding, right? So you're basically have that diversification versus just investing in like FTX or GameStop or something that then if it crashes, that's that. You just have your paper, your account, and that's it.
Okay.
So.
I heard a gentleman, he everything that you just said, he just simply put, he said, hey, if you're driving down the street, you want to know you're driving next to a licensed driver. You want to know, if somebody's driving without that license. And hey, well said.
Yeah. And I'll say, there's a lot of times where people, like you talk to a neighbor or a friend and they'll say, oh man, T, I made so much money on this. And a lot of times they'll tell you all the times they made money, but they won't tell you when they lost it, just like gambling. So I always tell people to be, curious and cautious when somebody's telling them about some get rich quick scheme or something like that.
Yeah.
Oftentimes it's too good to be true.
Do you encourage individuals that's in your seat to invest on their own as well, or do you encourage going managed as far as all in?
If they're interested in it and they have a passion for it, I think it's fine for them to do that with their play money maybe. And then if they have enough in assets and they really do have this goal where they want to retire at a certain time and they really don't know what they're doing on the investment side, I would say you want to have a professional handling that for you. And then you kind of have your play money on the side, which is a lot of fun.
Yeah. No, I think Jade, you bring up a good question kind of tied in where you're at. How often would you suggest someone review their 401k? I don't know. I don't hear it. It's not a conversation I hear at dinners often. Yeah. But how often would you suggest someone review it personally, but also maybe with another professional, maybe come to another professional with their 401k or their investments and have them review? What would you suggest? So
definitely at least once a year. I think the closer that you get to retirement, the more often you want to look at that to make sure that your asset mix sort of matches. So basically, like when you're young, 20s, 30s, even 40s, you might be 100% stock. And your 401k only has so many options that you're allowed to choose from, and you're sort of stuck there. A lot of the 401ks now have a target date fund, and so basically you plug in, this is when I want to retire, and it does it for you. And so with those, there's not much that you can do with it besides have it in that fund. And I like the ease of that for people because if not, how often are people really going back in and doing something with it? I will say, like, one of my big things that I tell people, if you're first starting to invest in a 401k and you're not maxed out and you get a raise every year, bump it up every year before you see your raise because you don't know what you're missing, right? It's just automatically there. You don't see it. And that's that.
Yeah.
So.
Yeah. No, and that's the same advice that was given to me as well. Yeah. John takes that advice.
John's a smart guy.
There you go. I got a two-part for you because as I'm sitting here, I'm listening to you two talk. You both are dressed to the nines. Two articulate young people, dress well. Do I have to be rich to have a wealth advisor to get some money management?
That's a great question, JJ. You don't.
So how much money, would I need for me to get advice?
So for what I do in our wealth advisory group at Lake City, our minimum's $500,000, but then we have a Lake City investment team, and they work with anything. 5,000, 10,000, whatever it is. And so there's always going to be a home for somebody to give you advice.
Okay, great. And that's the point I wanted to get out there to everybody. You don't have to be wealthy. The funny thing is, here we have a gentleman that's 13 years in the financial field, sitting here asking questions, using examples, and as he said, how often should I review? I want everybody, the common person, to know you should be out there. You get with professionals and let them guide you and steer you down that path. And one of the things that we often talk about on our podcast is relationships of banking. And, you get somebody you find that you're comfortable with, you get a relationship with that you can trust and let them guide you and navigate this path because it's tricky. And like I said, we've got, folks that, again, this is his life's work and he's got questions. So we know everybody has questions. But then the next thing I would ask, Can you kind of explain the process? How does that work? We come to you. I mean, is there a fee? What's charged? Can you explain that?
So for what I do, there isn't a fee that's charged. And even for a brokerage side, there's not a fee. Depending on who the audience goes to, there are some firms that will charge a fee to talk. They might charge a fee for financial planning. We don't do that because we feel like that's part of our duty and our service, because how am I going to know how to invest your accounts, how comfortable you are taking risk? So let's say that John actually doesn't spend a lot of money and is really frugal and is going to live out of his Airstream and, doesn't need much. Maybe we dial back his risk. Well, how would I know that unless I did some sort of a plan with John to see, okay, what do you need in the future? Oh, you are going to retire early, but you don't need a lot of money and that sort of thing. If I'm charging a plan or charging a fee for that, and there's firms that do, and that's fine. But for us, we just want to know that information so we can better help put together a sort of a solution.
Okay, great, perfect. T, I see your wheels started over there.
Yeah, I'm thinking of another friend. Another friend reached out. James. I got a lot of J friends. And he said he's got a 401k and he looked down at it, and it's kind of like you said, it's target date, right? So he picked a date on his 401k and it automatically formulates how he should invest, right? And he's looking at it, 2-3 years later, he's like, it's underperforming, right? The market is doing 8 to 12%, which last year did great, right? But let's say it's averaging 8 to 12%. Well, his investments are doing 6 something, right? What should he do?
It depends on what else he has available in his plan. So if his plan is made up of all target date funds and there's really not much else he can do with it, there's not. Because if he goes conservative, but he wants to retire later. So let's say it was 2022, and he's looking at it and he was like, man, down double digits. This random other, thing outside of the 401k performed better, but I don't have that option in my 401k. You don't want to just have that gut reaction and sell when it's low and then buy into something else. And then now you see this other thing that's low go up and you're like, oops, I just sold it, right? But that's behavioral. That's our mindset, right, as humans. And so a lot of times it's sort of talking you off the ledge and realizing, okay, I got to hang in there a little bit longer. This is a good fund. It's just going to take a little while to recover. The most important thing is, depending on how close you are to retirement, is when you actually need it. And that's usually why you want to go more conservative the closer you are to retirement, because you aren't able to weather those big storms if, markets are going down a lot.
Yeah. So do you find that, because this is actually was between two friends. So one said, no, you should be able to change that and manage your own. This person preferred to purchase their own, manage their own 401k. So do you find that the target date is very common where they won't allow you to manage your own as well?
It depends on the company. So each 401k plan is different, and your company decides what it is that they're going to allow in their plan. And so some companies will actually allow you to transfer out part of it and have somebody outside manage it, whereas others are just, no, it has to be in here. The reason the target date funds are so popular is because there are a lot of people that don't know how to invest their money. And maybe the company doesn't have somebody coming in to talk to them quarterly or whatever the case may be. And if that's the case, then they want to make sure that there's some easy way, right, for their employees to be able to invest. And so that's why the target date funds came about. And there's an act that was passed, Secure Act 2.0, which I'm not sure if, so that actually has different stipulations that'll come in play in 2025 and beyond for savings for people that have retirement plans. And it doesn't mean that you can't go in and change it, but it automatically puts a percentage of your paycheck in that company's 401k. And the reason is, they think that a lot of people would save if you made it easy for them. But if they have to go on and do something and they're not going to do it, then so if you think about it, if you're starting to save when you're 20 years old versus 35 versus 45, and usually as you get closer to retirement is when you're like, oh crap, I need to save money, right? Mm-hmm. But if you have all that compounding from when you were younger, that really adds up. And your other sources of income, usually when you're retired, Social Security, if we have it, right?
Yeah.
Pension, which most companies don't do a pension anymore. So it's just that 401k. And so that's why that act was put into place to set people up for retirement.
Nice. So kind of thinking about, a spinoff of that, right? Because I'm digging in on this 401k thing, right? I think it's important. I could talk about it all evening, but like, what are some other suggested ways to invest for the future, right? Are you a fan of the 529, which is the child savings plan? Are you a fan of, like I know we touched on, life insurance, which you don't sell, but are you a fan of any other form of future savings or investing?
Yes. So 529s, if you have kids that are planning on going to either private school or college, that's a great way to put aside money for them. In Indiana, we have what's called a College Choice Direct program. So there's no broker fee or anything like that. You're doing it direct with the state. And similar to the target date, you basically put in your kid's age of when they're going to need the money, and it automatically invests it for you. And on top of that, you actually get a state tax credit back. So it used to be if you put in $5,000, you get $1,000, and then it just increased. So if you put in $7,500, you get $1,500 back, a credit. So that's money back, not a deduction, which is awesome.
Oh, nice.
What if your child doesn't go to college?
That's a great question. So let's say your child doesn't go to college, or you have a couple kids and one goes to college and one doesn't, or one gets scholarships. Yeah. So if they get scholarships, you can actually withdraw the exact amount of the scholarship out from the 529 without a penalty. If they don't go to college, you can change the beneficiary to another kid that does or a grandkid that does. And then there's a new, and I think this was also part of Secure Act 2, maybe. So many rules, I don't know. Yes. But with that, you can have it for the beneficiary towards the retirement. There's a certain amount that can be rolled out into a Roth.
Okay, that's good to know. Because because I know there was people that didn't do a 529 just because my kid's grades aren't that good. I'm not sure if he's going anyway. So, yeah.
And, if you want, you can invest that money outside of, and then let's say your kid is going to college, you could put it into that account, only have it in cash, get your tax credit, and then swoop it back out to pay for college. And there's a lot of people that'll do that, too, because they're trying to just take advantage of the credit.
Gotcha.
Because it's free money.
And I appreciate that because Tia brought up something. He brought up life insurance as far as leveraging money, and you said you don't do that. And you spoke to different products that are out there. That was something I wanted to circle back to and say, what are some other ways that you can make money off your money? That's in your scope. Can you touch further on? You just gave us one, but some other, you said special products that we have.
So health savings accounts are another one. So with health savings accounts, you're putting the money in before taxes. It's growing tax deferred. And then you're taking it out, and as long as you're using it for your health care, it's free. You're taking it out without any sort of penalty, tax free. So that's a great way for your money to grow. There's limits on it, depending if it's family or individual. But if you're able to max it out, that's money that you have access to later. Roth IRA, so let's say you're not at too high of an income level, you could put money in that account, and it does have the age stipulation. But if you've had the money in there for 5 years, you can take out what you put in, not the growth, but the other part of it, without a penalty, as long as you follow the other rules.
So I just had a question two questions actually, and then I'll be good. Maybe John will be good. But question one, 529. One, can I invest if I don't have a child? Can I have a 529 with no children?
There really wouldn't be much of a reason to do it.
One day, I want to.
Oh, I'm sorry.
I don't have. I'm just saying, if I'm planning on it, but right now I don't have any child. Can I get an advantage on that?
I thought you were going to say, can I borrow someone's child?
that was my question too. But thanks for getting us out of here.
He's got nephews.
Right.
No, but just thinking, for someone that plans to have a child, plans to have family, but right now just want to be ahead of the curve. Is that ahead of the curve type of thing, or no, you need to wait?
It might be. So you would have to put somebody on there as a beneficiary. So You'd be the account owner. You'd have to have a beneficiary, which I suppose you could possibly put yourself down and then change it to somebody else. But typically you have the child. Someone. Yeah, you have. Yeah.
And then is that money being invested while it's in the 529? Mm-hmm. And do you get to control those funds?
Yes, you do. So, for example, for the College Choice Direct, when you log on, you'll see all these different options you can choose from. But once again, they made it sort of easy with the age-based where you can just pick that. So you don't have to pick the different funds. You could actually not do direct. I forget what it's called, college choice not direct. I don't know. But that's where you have a broker that you work with that can help pick it for you. But those will then have a fee because the broker has a fee on it. So I always recommend the direct because they already have that built-in plan.
Nice. John's learned enough. I can't wait to give him a call.
Reneta, we're going to invoice him.
All right.
Make sure you get him, as soon as the segment is over.
I accept Venmo, so.
But, hey, it's been a pleasure. You see, our time has flown. I told you I had a talker here full of questions. You answered everything, a wealth of knowledge actually from both of you guys. Sure. And to all our listeners, I mean, again, hope you learn some things. These are things that we all need in our life to help us better ourselves. Think for the future. I mean, again, Tim had a great question. He wanted to retire early. Everybody wants to retire early. She hit him with the health care. Again, if you're retiring before you're going to get Medicare, that's something you have to think about. That's a big chunk of your income. But it actually speaks to why we see so many people that actually have enough to retire, but they have a little piece of a job to get that healthcare piece, to get that healthcare insurance. So again, you guys put a lot of good stuff, on our viewers' mind. If you need anything, again, feel free to reach out. Reneta is at Lake City Bank. Again, a wealth of knowledge there to help. And Tim has been an active member in Fort Wayne, serving our youth throughout Fort Wayne in a variety of capacities, and he's always been passionate about financial literacy. It's one of the reasons I wanted to get him on. Appreciate everybody coming out tonight. Until next time.